I like Lucero because anytime you combine two provisions that people often, get confused with, I think it's a fun one to try to learn. And there's a couple moving parts here. Sometimes I'm always not sure which one to think about presenting first, but let's just lay out the facts and then we can attack the issues. And I guarantee the one issue is one that every accountant still struggles with. It's one of those rules that's hard to keep in your brain. In Lucero, we got a guy who owns a rental property, and the thing is, it's a short-term rental, right? So it's like an Airbnb. People come in, they leave, okay? And that becomes very important here. So they rented this thing for 146 days in one year, 152 in the next, and the number of days become important as well because we're going to talk about the rules for, what really makes something a rental property here in a moment. Now they used a management company to handle, again, day-to-day operations, but they set the rates, they approved expenses, blah blah blah, right? And then they did a lot of the work on the property themselves. So they would go there, and husband and wife, they do some landscaping, some cleanup, take some inventory. The wife would clean and decorate and do stuff like that. But they were there quite a bit doing repairs. And then they would go there for just a family trip during Christmas. Okay. Now, they did not keep a great set of records as far as how many hours they worked on the property. And because they had a management company, it's going to become very important. They were able to get to about 250 hours, if we want to call it, and that number is important. Stick that in the back of your brain. About 250 hours for each of the 2 years at issue here. Okay. And what happened is the property produced losses, and they used those losses. And we're 3 cases into our top 10, and they all have been initiated because of what? Somebody using losses that the IRS is
Hmm.
questioning. And so we can't stress enough how important it is before you drop a loss on a return. You've kind of jumped through all the hoops to make sure you're doing the right thing. So there's a lot to unpack here. I love cases that have two distinct issues. In this case and the next case, both do something like that. So what's the first issue I want to address here? All right. The first issue, and I know this trips people up, is you've got a rental property that we know has some element of personal use because they go hang out there every Christmas, right? And so when you have a second residence that has even the smallest degree of personal use, you got to consider Section 280 Cap A. And 280 Cap A is a tricky one, man. I taught it in grad school last year, and you can just see the kids' eyes kind of glaze over. But basically, 280 Cap A takes a property, a residence that you own, and establishes a general rule that, hey, no deductions attributable to a residence are allowed. Now, we know there's exceptions to that, right? 163H, we get mortgage interest. 164, we get property taxes. But other than that, you pay your utility bill or something like that, you don't get a deduction for that. So, but then 280A contemplates that, hey, some residences have rental activity, which, is a 212 deduction. You should be able to take expenses against that. And so whenever we have a property that's partly used rental, partly used personal, we got to figure out which of these 3 buckets it falls under. And like I said, this will confuse people until the end of time. The one extreme, and I find this, can be completely tangential, but such a great discussion about the tax law, is if you own a house and you rent it for less than 14 days the entire year. You know this, Damon. It kicks in one of the funnier rules in the tax law, what they call the master's exception, right? And what it says is you rent a house for less than 14 days in a year, and you don't hear this much in the Internal Revenue Code, pocket the cash. Don't pay
Hmm.
any tax on it, right? And why do they call it the master's exception? Because the rumor has always been that wealthy homeowners around Augusta, in Georgia, the Augusta Golf Course where the Masters is held, um, lobbied their powerful friends in Congress to say, look, I can get 30, 40, 50 grand to rent my house out during the tournament, but I'm not a landlord. I don't rent it for the rest of the year. Throw me a bone here. I'm just doing a one-off rental, and you know, help me out. And so we've got this rule under 280 Cap A that says you rent for less than 14 days, You pocket the cash, you don't pay tax. Obviously, you don't get to deduct any of the expenses attributable to the rental. But my gosh, if there is a provision that more, how should I put this, like abruptly favors the rich, I don't know about it. And the thing is, you could say, well, hey, anybody can rent their house for less than 14 days. Yeah, you can, but nobody's beating down your door to rent your house in most jurisdictions in this country, right? There are certain favored areas, and they happen to be the areas where you can fetch a huge sum for renting your house. And so that's one extreme, and that's certainly not what's going on here. The other extreme is if you rent the house, but then you use it for personal purposes for the less than the greater of, and anytime you start a sentence with less than the greater of, you're in the tax law and it's a pain in the butt, right?
That's right. Yep.
Less than the greater of 10% of the days it was rented or 14 days, then it's the opposite. If personal use is so low that it's less than the greater of 10% of rental days or personal use, then basically it's a rental property. And what's important about being a rental property is it means you include the income, you get to take the expenses, and those expenses can actually generate a loss, okay? If, however, right, your personal use is greater than the greater of 10% of rental days or 14 days, then you have a mixed use property. A little bit of rental, a little bit of personal. When that happens, then you have, again, a set of rules that say you pick up the income, you take the deductions, but only up to the amount of the income. So you cannot generate a net loss. And so the first threshold issue here in Lucero is, okay, do you have the second category we talked about, where it's a pure rental because your personal use is low enough, or do we have the third category where your personal use is higher and so you can't deduct the loss at all, in which case this case is closed because there's no loss to even deduct.
Right.
And so I thought in Lucero they were pretty friendly and favorable to the taxpayer. They basically believed him when he said that the time he spent there doing repairs was truly for repairs, because what you'll find under 280 Cap A little d, when we say personal use encompasses far more than just me going there with my family for Christmas, right? Like if you rent it to a buddy for less than anytime it's rented for less than fair market value, that's a personal day to you. If you let somebody stay at your place for free because they let you stay at their place for free, that's a personal day to you, right? If you rent a house to a family member, even if it's for fair market value, if it's not for use as their principal residence, that's a personal day to you, right? So we got to make sure we understand that when we say personal days, it's more than just, hey, me and the kids are hanging out by the pool. A lot of things can be personal days. But for Lucero, they basically said, we believe you. We think that all the days you were there with your wife, you were working except Christmas. So if we give you Christmas, but then you said you rented it for 150 days a year, well, your personal days are less than the greater of 10% of the 150 rental days, 15 or 14, so it's less than 15. So you've got yourself a rental, right? So you can take this loss. But that's what's so amazing about the Internal Revenue Code is you go through all that trouble to get this loss, but now the case is really just beginning, because what did we just learn in Hackett? We learned that, right, losses from a rental property default to being what? Passive, right? So now can he use these losses? This pulls in, right, the 469 regs. And what I said before, which is that not everything that looks and feels and smells like a rental is necessarily, right, a rental activity. And so what we have here that people around the industry have to get comfortable with is the 469-1T regs that list out 6 or 7 exceptions to rental properties. And the first one, the one that's going to be most common in today's world, is rentals where the average period of customer use is less than 7 days. They're not rentals. So if you add up all the days things been rented during the year, divided by the number of different tenants, right? If on average people are renting it for less than 7 days, it's not a default rental activity. And what did we say under 469? If something's not a default rental, it goes into category 2, and whether it's passive depends on whether or not you what? Materially participate. So now we got to ask, did Lucero materially participate? Now I said to you, hey, there's 7 tests. The easiest one is you get to 500 hours, you materially participate. But Lucero, we said, if you remember, he spent about 250 hours. So does that mean he's doomed? No. You can materially participate with fewer than 250 hours if no other one party spends more hours on the property than you. And this is the problem for Lucero, because if you remember, he hired a management company, right, to
Right.
oversee the rentals. And so what they said here is like, look, we see your 250 hours. We definitely have some question of some of the hours, and it goes back to exactly what we just talked about under Hackett, right? He recorded time spent paying bills, coordinating with the management company, preparing the tax returns, which the court found some of that time to be investor type time, which I have a little bit of a problem with. Paying bills, I just think it's inherent to owning a rental property. So I don't know how that would be viewed as investor time, but I could see why preparing the tax returns potentially gets you there. But they said same problem as Hackett. You don't manage the property day to day, and so we might have to kick some of your hours out. But more importantly, you haven't established for us. It's not enough to establish your own hours. Because you're under 500, we need to know how many hours what the management company spent. Because if they
Mm-hmm.
spent more than you, you're out. And so basically, this case ended up ending kind of anticlimactically, where they just said, you can't prove to us you spent more hours than everybody else did, than any one person did. And so you can't prove you materially participate. So think about the case. They dodged the 280A bullet. Turns out it's a rental. They dodged the 469 bullet. Turns out it's not default passive as a rental, but it still ends up passive because they can't prove they materially participate, right? And so they end up with passive losses that they can't use. Now, one takeaway I had from this case that's been driving me a little crazy is they did not allow him to count his time driving back and forth to the property. And the reason it drives me a little crazy, I think it's the right answer, but we had a case called Leyh from a couple of years ago, Leyh, where a taxpayer owned 12 rental properties and they counted her time traveling to the properties in her material participation for being a real estate pro. I'm guessing the difference is with 12, maybe they're counting the time going from property to property, whereas with Lucero owning only one property, maybe they viewed driving there and back as akin to a commute to work.
Commute. Yeah. Yeah.
But I don't know. I love that case because you just never know where the next attack is coming from. Like you got to beat 280 cap A, you got to beat 469 default passive rules, and then you still get hung up because you can't show you materially participated more than any other one parties.